I mentioned before that ESG is a fundamental part of ensuring the long-term sustainability of an organisation, and that comes to life throughout the entirety of a life cycle of an asset and our investment process. So our tenants' expectations are ever increasing, and this across all topics of ESG. Our markets in which we invest in are, and the expectations of our investors is also ever growing more prescriptive. So to ensure that we maintain and ensure the optimal return that we can over the longest duration possible, and ensuring the assets that we provide generate the returns expected and deliver on these, we need to ensure that ESG is genuinely integrated, not as a side or topic, but truly integrated in the activities that we undertake across all of our investments. So what does that look like in reality? So when we're looking at an ESG overview of any investment, we're looking at its potential today and how that would meet the current market expectations, but also what that would likely be, or how that would likely be perceived in the next few years, and therefore understanding what improvements or what initiatives can be undertaken to maintain the asset's value to its highest return possible. In addition to that, and to take a real life example, a neighbours rating or any ESG rating, a number of years ago, a neighbours rating or having a high level neighbours rating, whilst a great thing to do, would have been deemed sufficient to generate and determine an asset as having a high ESG profile. Today, whilst the neighbours rating is still very much important and sought after, that has now become an expectation. So that's no longer a premium ESG initiative, that's kind of a basic expectation. So therefore, the benchmark or the marker of where ESG levels sit is ever evolving. So to ensure that we implement and achieve these long-term investments, we need to ensure that we follow through and deliver on our ESG strategy, which in turn delivers the ESG results that maintain these investment returns.